We then need to look at an interest rate futures contract. And please note, futures contracts are traded on the derivative market of the JSE. So they are traded on a formalized exchange and not over the counter. And please remember, as soon as we are trading on a formalized exchange, then we have certain standards. So the contracts can't be customized to your exact requirements, but instead we have certain standard contract sizes, etc. So you need to study, please. The standard contract size is 100,000 Rand. The value of a tick movement is 2.50 Rand, and the pricing of the contract is 100 minus the yield. So once again, guys, up front, I'm just showing you all of the rules that you need to study. I will then show you the application of the rule when we get to the example just below. So all of this needs to be studied, please. Then, please note, if we are dealing with an investor is going to be worried about interest rates decreasing. And if they're worried about interest rates decreasing, that means they need to go long. On the other hand, if we are dealing with a borrower, they are going to be concerned that interest rates increase, and they then need to go short. Now, please remember, if you go long, that means you buy now and you sell later. Whereas if you go short, it means you sell now and you buy later. Then please note also, as with a forward rate agreement, the futures contract is also a binding agreement. So even if the underlying transaction falls through, each party still has to deliver in terms of the futures contract. So let's look at the example below. This is very similar to the last example. The date today is the 1st of July 20x6, and Baxter Limited intends to borrow 10 million Rand from a local bank on the 1st of October 20x6, at which point in time they will fix their rate for the 12-month duration of the loan. Okay, so let's look at this on a timeline. Today is the 1st of July 20x6, and the company is going to enter into a loan agreement on the 1st of October 20x6, so 3 months from now, and it's a 12-month loan, so that's going to be repaid on the 31st of September 20x7. So this is where we are sitting today. 3 months from now, they are going to enter into a loan agreement for 10 million Rand. We are then told that they are concerned that interest rates are going to increase before they enter into the loan agreement, and they want to hedge against the impact of higher interest rates for the 12-month period. So please note, guys, when they actually enter into the loan agreement on the 1st of October 20x6, they will be able to fix the rate of interest at that date. However, they are concerned that interest rates are going to increase before that date. So we are worried about interest rates increasing during this 3-month period. If I entered into the loan agreement today, I would be able to fix the interest rate on that loan today. However, because they are only entering into the loan agreement 3 months from now, they will only be able to fix the interest rate 3 months from now when they actually enter into the loan agreement. So what are they worried about? They are concerned that interest rates are going to increase during this period and are trying to hedge against the increasing interest rates. Baxter will make use of a 3-month JIBAR contract, which will close out on the 1st of October 20x6. You can assume that the yield quoted at present on the 3-month JIBAR is 7.5%, and they let the contract expire on the 1st of October 20x6 when the yield is 8.25%. So if we just include this on our timeline, the JIBAR yield at present, the yield is 7.5%, And 3 months from now, the yield is going to be 8.25%. Then in terms of the required for this question, we need to calculate the net borrowing cost of the loan if on the 1st of October 20x6, they fix the rate of interest on the loan at 8.25%. So when they actually enter into the loan agreement on the 1st of October 20x6, they manage to fix their interest rate on this loan at a rate of 8.25%. So the first thing we need to do is determine which contract should be used. Now, it's very simple in this question because we were only given one contract. We were given the 3-month JIBAR, and we were told that Baxter is going to make use of a 3-month JIBAR contract. So you didn't actually have to decide between various different contracts. But please note, if they do give you lots of different contracts, in this question, we are dealing with short-term risk. They are worried that interest rates are going to increase over the next 3 months before they enter into the loan agreement. So because it's a short-term risk, we can use a short-term contract. So that is why we are looking at the 3-month JIBAR contract. Please note, if we were looking at long-term risk, we would then use a long-term bond future. So if the risk is long-term, the futures contract must also be long-term. So we would then use a long-term bond future. However, if the risk is short-term, then the futures contract must also be short-term. So because we are dealing with short-term risk in this question, we are going to use the 3-month JIBAR futures contract in order to hedge this risk. Then next, we need to determine whether the company should go long or short. Now, in this example, we are dealing with a company that intends borrowing 10 million rand. So we are looking at a borrower, not an investor. So a borrower is going to be worried that interest rates are going to increase. And if we are dealing with a borrower, we always go short. And going short means we sell now and we buy later. So we can include that in our solution. Which position should they take? They are going to borrow funds and they need to hedge against interest rates increasing. So they should take up the short position where they sell now and they buy later. So let's actually work out what the impact of this is. We are now going to calculate the pricing of the contract. And we calculate the pricing of the contract by saying 100 minus the yield. So the pricing of the contract today is going to be 100 minus 7.5. And the pricing of the contract 3 months from now is going to be 100 minus 8.25. So in order to work out the price of the contract, it's just always 100 minus the yield. So a simple calculation, you can see it in our solution. Now the contract is going to be priced at 92.5. 100 minus the yield of 7.5 gives me 92.5. And 3 months from now, the contract is going to be priced at 100 minus 8.25, giving me 91.75. Now remember, we said taking up the short position means that I sell now and I buy later. So I'm going to sell now for 92.5 and I'm going to buy later or buy in 3 months' time for 91.75. So you can see I'm selling for more than what I'm buying at. So we have a gain of 0.75 on this futures contract. Now, please note the gain of 0.75 is referred to as a 75 tick movement. And I'm going to show you now where that comes in our calculation. But first, before we can perform that calculation, we need to determine the number of contracts that are needed. So please note this is a 10 million rand loan. And we also know that because futures contracts are traded on the derivative market of the JSE, they are going to come in a standard contract size, and my standard contract size is 100,000 Rand. So we take the full loan amount of 10 million Rand, we divide by 100,000 Rand, and that is going to give me 100 contracts. Now you just need to be careful. Please note, this futures contract is a 3-month JIBAR. We are not trying to hedge the risk for a period of 3 months. They are trying to hedge the risk for a 12-month period. So what we need to do is we've calculated here that this gives us 100 contracts. However, that is for a 3-month JIBAR contract. So that is only going to hedge interest rate risk for a period of 3 months. We are trying to hedge risk for a period of 12 months. So we need to multiply that by 12 over 3 so that we can calculate the number of contracts that we need in order to hedge the risk for a 12-month period instead of a 3-month period. So we actually need 400 contracts. We will then hedge the risk for a 12-month period. Then lastly, we can calculate the financial impact of using this futures contract. In step 3, we calculated that we make a gain of 0.75 on the futures contract. And I told you that that gain is referred to as a 75 tick movement. Now, if you go back to the rules on the previous page, the value of 1 tick movement is 2 Rand 50. So if we want to calculate the Rand value of this gain, we know that at 75 ticks, the value of 1 tick is 2 Rand 50. And we also calculated in step 4 above that if we want to hedge interest rate risk, we need 400 futures contracts. So that gives me a gain of 75,000 Rand. So please note, this is 2 separate transactions. We have the loan agreement, which is 1 transaction, and then we have the futures contract, which is a separate transaction. We have calculated that on the futures contract, we will make a gain of 75,000 Rand. Ignoring the futures contract, what is the interest that the company would pay on this loan? We were told when they actually enter into the loan agreement on the 1st of October 20x6, they will fix the rate of interest for the loan. So they will fix it at a rate of 8.25%. So for this 12-month period, they are going to pay interest on the 10 million Rand loan at a rate of 8.25%. So if they don't hedge interest rate risk, they would pay interest of 825,000 Rand. That is interest for the year at a rate of 8.25%. So the net effect is, after taking the gain from the futures contract into account, we are only paying interest of 750,000 Rand, meaning that we are effectively paying interest at a rate of 7.5%. And the reason why I refer to this as a perfect match is look at what we've managed to do. The company was worried about interest rates increasing during this 3-month period. They knew when they actually enter into the loan agreement, they will be able to fix the rate of interest on the loan. And when they actually enter into the agreement, they do fix the rate of interest. However, they were worried about interest rates increasing during this 3-month period. So look at what they've managed to do by using the futures contract. They've managed to reduce their effective interest rate from 8.25% to 7.5%. So it's as if they enter into the loan agreement today and they fix the rate at today's rate. So that's why I have a perfect match. We purchased the correct number of contracts to make sure that we hedged the risk for a 12-month period instead of just a 3-month period. So we've effectively reduced the interest rate from 8.25% to 7.5%. We then need to look at an interest rate option contract. And please remember, options contracts can either be traded over the counter or on a formalized exchange. So obviously, if they are traded over the counter, you can customize the option contract to meet your exact requirements. So because of this additional flexibility, where they are traded over the counter, they are generally more expensive than options that are traded on a formalized exchange. And then please remember, if they are traded on a formalized exchange, we are going to have standard contract sizes, and the standard size is 100,000 Rand. Then remember, the benefit of an option is it gives the holder the right but not the obligation. So you will remember a forward rate agreement and a futures contract are binding on both parties. So even if the underlying transaction falls through and the company doesn't actually enter into a loan agreement, they still need to honor the forward rate agreement or the futures contract. However, with an option, we have a lot more flexibility, and you only exercise the option if it is in your favor. However, you need to pay a premium for this additional flexibility, and that premium is paid regardless of whether the option is exercised or not. So because of the premium, option contracts are normally more expensive than any other derivative. Then once again, before you attempt a question, you need to know whether you are looking at it from the borrower's or the investor's perspective. Remember, where we are dealing with a borrower, they are going to be worried about interest rates increasing. On the other hand, if we are dealing with an investor, they are going to be concerned about interest rates decreasing. So please note, where you have a borrower in a question, you are going to recommend that they go for the put option. And what a put option does is it sets an interest rate cap. And the interest rate cap is the maximum interest rate that the company or the borrower would be exposed to. So if we look at this on the graph just below, in this example, I've set the interest rate cap at 8%. You can see it's just the gray line over here at a rate of 8%. So with an option, we know the borrower will only exercise the option if it's in their favor. If it's not in their favor, they don't have to exercise the option. So what's important to note, if you are borrowing money, as long as the market-related interest rate is less than the cap, so let's say, for example, the market-related interest rate is 7%. The borrower is going to rather pay interest at a rate of 7%. They won't exercise the option, because if they exercise the option, they will pay interest at a rate of 8%. So if the market-related rate is less than the interest rate cap, they will not exercise the option. So if we look at that on the graph, as long as the interest rate is less than the cap, they won't exercise the option. However, when the market-related rate exceeds the cap, so let's say, for example, the market-related rate over here is 9%. They would then exercise the option because the interest rate cap will set the maximum interest rate for them. So even though the market-related rate is 9%, when they exercise the option, it limits the interest to a rate of 8%, or it caps their interest at a rate of 8%. So please note, if the market-related rate is less than the cap, they will not exercise the option. They will rather pay interest at the lower rate. However, if the market-related rate is above the cap, they will then exercise the option so that they only pay interest at a rate of 8%. On the other hand, if we are dealing with an investor, we said that investors are worried about interest rates decreasing. So investors would go for a call option, and the call option allows them to set an interest rate floor, or the minimum interest rate that they are prepared to accept. So in this example over here, I have an interest floor of 6%. So please note, as long as the market-related rate is above the interest floor, the investor will not exercise the option because they would rather earn interest at a higher rate. So if the market-related rate is above 6%, they won't exercise the option, rather earn interest at a higher rate. However, if the market-related rate drops below 6%, they will then exercise their option so that they don't receive interest at the lower rate. Instead, the minimum amount of interest that they receive is 6%. Then please note, guys, an interest collar just combines the cap and the floor into a single position. So you can see the graph below includes both the interest cap and the interest floor. I don't want to spend too much time looking at an interest collar because chances are in your test or your exam, you are either going to be given a company that is a borrower or a company that is an investor. You are not going to be looking at this calculation from the perspectives of both parties. Either you're looking at it from the borrower's perspective or you are looking at it from the investor's perspective. You are not going to look at it from both. So I don't want to spend too much time looking at interest collars. Please just note that an interest collar combines both the cap and the floor into a single position. Let's look at the example. Volcano Limited intends borrowing 50 million rand at the beginning of July 20x6. The borrowing will be for a period of 6 months. So it's going to be paid at the end of December 20x6. They are concerned that interest rates will increase and they wish to make use of an interest rate cap or a put option that is quoted on the yield X of the JSE. So two important things over here. First, they've told me we are looking at a put option or an interest rate cap. Please note, I didn't have to tell you that in the question. You should know because we are dealing with a company that is looking at borrowing money, they are going to be concerned about interest rates increasing. So they are going to want an interest rate cap or a put option. So I don't need to tell you that in the question. You must be able to come up with that information on your own. And you will see it is also included in our solution for completeness sake. So they should purchase a put option or an interest rate cap because they want to borrow money and they are worried about interest rates increasing. And we are also told that this put option is quoted on the yield X of the JSE. So we saw that options contracts can either be traded over the counter or on a formal exchange. So we are dealing with contracts on a formal exchange, meaning that we have a standard contract size of 100,000 Rand. In addition to that, the following conditions are applicable. The strike date is the 2nd of July 20x6. The option premium per contract is 120 Rand. And please remember, this premium is paid regardless of whether the contract is exercised or not. And lastly, we are told that the strike rate of the option is 8.45%. So that is their cap, meaning that is the maximum interest rate. And you then need to assume that the option allows for fixing the interest rate for a period of 3 months. And on the strike date, the actual interest rate in the market is 9%. In terms of the required, we need to calculate the effective annual cost of borrowing if they make use of the traded option. So in the first step of my solution, I say that we are going for the put option or the interest rate cap because the company is looking at borrowing money and they are concerned interest rates are going to increase. So always start with that. Discuss whether it is a put option or a call option. Then calculate the number of contracts. The loan amount is 50 million, and because these contracts are traded on a formal exchange, we have a standard contract size of 100,000 Rand. Now guys, please just be careful. When we're calculating the number of contracts, we always need to match the term of the contract to the term of the loan. So please note, we were told that this option will allow them to fix the interest rate for a period of 3 months. However, we are not dealing with a 3-month loan. We are dealing with a 6-month loan. So we want to fix the interest rate for a period of 6 months, not a period of 3 months. So what we need to do is multiply that by 6/3 so that we can get the number of contracts. We did a similar calculation when we looked at the futures contract. You always match the term of the contract to the term of the loan. So what you do is you multiply by the loan term and you divide by the option contract term. We then need to determine whether they are going to exercise this option or not. So please note, on the strike date, the interest rate in the market is 9%. So if they don't exercise the option, they are going to pay interest at a rate of 9%. However, if they exercise the option, their cap is 8.45%. So if they exercise the option, they will only pay interest at a rate of 8.45%. So because the market rate is higher than the cap, they would exercise the option. It's obviously better to pay interest at a rate of 8.45% instead of a rate of 9%. So in terms of the discussion, on the strike date, they need to determine whether they should exercise the option or not. And because the market rate is more than the strike rate, they will obviously exercise the option. So let's look at what the outcome of this transaction is. First, let's calculate what the interest would be if they did not have the option contract. So if they didn't have the option contract, we have a loan of 50 million Rand. Interest would be paid at a rate of 9% because that is the market-related rate on strike date. And please note, strike date is the 2nd of July. When is the company entering into this loan agreement? At the beginning of July. So at the beginning of July, interest rates in the market are 9%. So if they did not have the options contract, they would pay interest at a rate of 9% for a period of 6 months. So ignoring the options contract, that would be their interest expense. However, if we take the option contract into account, we can see they are going to make a gain on the option contract. And the gain is the difference between the market-related rate and the strike rate. So they've got a gain of 0.55%. And that is obviously based on the loan amount of 50 million Rand for a period of 6 months. So if we take that gain into account, the interest is going to decrease. And you don't have to perform this calculation. I've included this for completeness sake to show you that by exercising the option, they've managed to reduce their interest from a rate of 9% to a rate of 8.45%. By taking this gain into account, their interest has actually decreased to 8.45%. Then please note, we need to take the premium into account. And the premium is paid regardless of whether they exercise the option or not. So the premium actually makes the options contract very expensive. If we go up, you can see they have a premium of 120 Rand per contract. So we have 1,000 contracts that we calculated in step 2. So that gives us a premium of 120,000 Rand. So in terms of the required for this question, we needed to calculate the effective annual cost. So if I want to calculate the cost as a percentage, I take the net cost, I divide by the loan amount of 50 million, and then please note that this is interest for a 6-month period. So if I want an annualized percentage, I need to multiply by 12 over 6 so that I can see what the interest rate is for the period of a year. So please note, the interest rate isn't actually 8.45%. If I ignore the premium, I've managed to cap the interest at a rate of 8.45%. However, if I take the premium into account, the interest rate is then 8.93%. However, the company is still better off because without this option, they would have paid interest at a rate of 9%. So by having this option, they've managed to reduce their interest to a rate of 8.93%. Now, please note, this option is only going to be worthwhile if the cash settlement or the gain is more than the premium paid. So in our example here, the gain is higher than the premium that is paid on the option contract. So because the gain is more than the premium, the company is better off as a result of the contract. However, if the gain is less than the premium, then the company will be worse off as a result of the options contract. So please be aware of that. Then lastly, in this example, we had an option that was traded on a formalized exchange. So that's why we used the standard contract size of 100,000 Rand. Please note, if it's traded over the counter, then obviously there is no fixed contract size and the company will be able to purchase an option that will meet their exact requirements.